Spot prices for nearly all precious metals have been dropping over the past few weeks, and particularly in silver, we are reaching a pretty significant resistance level of the $16 range all the way down to $15.50 an ounce. Currently, spot's hovering just above $16 an ounce, but it's quite possible that early next week we could see a dip below 16 and into the mid-15s. In the last 2 years, this has occurred on about 3 occasions, and the price rebounds were fast. So it's just a heads up for those out there who are dollar cost averaging their stacks this summer. On to this week's interview, which was recorded at an hour I should never have to wake up at. No, I'm only kidding. 6 a.m. we recorded this, 6 a.m. Eastern. I spoke with Ronnie, and you're about to hear and see it on YouTube. Have a great weekend, everyone. Hello and welcome to this week's Metals and Markets Update. I'm your host, James Anderson of SD Bullion. With us this week is Ronnie Stoeferle. He's author of the widely popular annual In Gold We Trust report. He's also author of the best-selling book, Austrian School for Investors. Ronnie, thanks for taking your time to be with us today.
Thanks a lot, James. It's a great pleasure. And I know over there it's pretty early, so I really appreciate it. I hope you had a good cup of coffee.
That's no problem. It's no problem at all. I definitely did. So I wanted to start today by just getting a background for our listeners in case they're not conscious of the annual In Gold report that comes out. I wanted to ask you about the origin of the free PDF that you guys publish every year. When did it begin, and kind of why did you guys do it?
Well, I started writing the gold report in 2007 already, when I was a young, ambitious analyst at an Austrian bank, Erste Group, and I basically always really enjoyed investing. I bought my first stocks when I was I think 13 or 14, went through the .com bubble and the bust. Learned quite a lot from it, and always kept investing and trying to improve my toolbox of investing. And 2006 I started investing in small mining companies, and I was very fortunate to become an investor in Osisko, which turned out to become really one of the biggest mines in Canada, and was I think a 40-bagger, really tremendous performance. And then I went to my boss and said, I really got interested in the gold space and in the mining space. Would it be okay for you if I would write a special report on gold over the weekends? And he said, yeah, just go ahead, and gave me some budget. And this is how we came up with the first In Gold We Trust report. And 12 years later, it's one of the most widely followed publications on gold. This year's edition was I think 230 pages. We really try to deliver this holistic view. So it's not only about gold itself, of course, it's about everything. It's about politics, it's about geopolitics, it's about our society, it's about inflation, our monetary system, it's about central bank action, but we're also, of course, writing about mining stocks. We're analyzing gold from a technical point of view. We are having great interviews in the report. So I think this unique way to analyze and write about gold, this is what kind of makes it so special. And this is why the report, we got already more than 1.2 million readers for this year's report. So we probably hit a new all-time high. Unfortunately, not with gold or silver, but with the readership of the report. But I think that gold and silver will follow sooner or later.
Well, it's highly encouraging to know that there's over 1 million people out there with heads on their shoulders and common sense. You go ahead.
Well, sorry, for interrupting, but for me and for the whole team, it is really important to educate people. Yeah, it's important to go below the surface and tell them why populism all over the globe on the right spectrum and also on the left side of the spectrum is coming up, that it is also a consequence of our monetary system, Cantillon effect and so on. We really try to educate people about the purchasing power of fiat currencies and how gold over the long term really preserves your purchasing power. We're writing about monetary reforms, we're writing about hyperinflations and so on. So we really try to make people kind of think about the system, think about money, think about long-term investing, and that's really something that we really enjoy and where we get tremendous feedback from people all over the globe.
Well, yeah, I have to back up your statements here by saying every year I've been in the industry, whenever your report comes out, it's just, immediately I got to find it and scroll through it and see and read it and see the charts. And, you keep it in a file on your desktop to go back and look at, to use as illustrations occasionally on Twitter or this or that. So it's a handy resource for people to understand. Obviously gold, for those who don't know gold, they don't understand, I think, the complexity involved to have a better feel for what's going on in the fundamental and the macro level. So in order to understand gold, you have to understand, like you mentioned, so many various things, geopolitical, what's going on with interest rates, what's going on with various things in the economy. So I'm glad that you're out there and that there's somebody who's willing to put the work in to get this information out. It's really great stuff.
Thank you very much. Appreciate it.
So Ronnie, you're described as an Austrian economist. How did you get involved with the Austrian school, and at what point did it happen for you?
Well, it was actually I am Austrian, so I was born in Vienna, and funnily enough, all over the world, the Austrian School of Economics is really gaining in importance. People, especially young people all over the globe, start studying, start reading into Austrian economics, basically take the red pill, because it's mostly the opposite of what mainstream economists, politicians, academics and so on really teach or tell us. So for me, I think it was a quote by Ludwig von Mises from his book on liberalism that really got me into the Austrian school. And it is very sad that it's I studied business administration and economics over here in Austria, but the Austrian school is not taught at all. And I think I just attended a conference in Poland a couple of years, and it seems that in former socialist countries, people, especially the young people, they know much more about the Austrian School of Economics, about libertarianism and so on, because they know how socialism and oppression feels. Mm. While in the Western industrial world, where we're still living in welfare states more or less, people don't care about those ideas yet. Mm. Yeah, I mean, the Austrian school is very much, I would say, the common sense school of economics, or the no free lunch school of economics, as a friend of mine once said. Yeah. And it seems that many, especially businessmen and people that have got no clue about economics and those sophisticated models that are taught, they get it more easily, because, as I've said, it is common sense. So we always want to quote great Austrian economists like Ludwig von Mises, Hayek, of course, Murray Rothbard, Karl Menger, and so on in the report. And this is also kind of a aim that we've got to educate people about the Austrian School of Economics, because it is very important to study those old ideas, because the principles of economics, the fundamental laws, they cannot be changed at all, not by politicians and especially not by central bankers.
Right. They could be delayed perhaps, but they're immutable laws. I totally get what you're saying. So today we have we have 5 slides that we're going to be going through. Just a little sample for those out there who have yet to see the In Gold We Trust report. I went through and grabbed what I thought were some relative slides that were important. For those out there who are listening on their, perhaps on their iPhone or iTunes, if you want to see these charts as we go through it, this interview will be on YouTube as well, and the charts will be in the interview. So I suppose we'll get underway with the first chart. I believe it's S&P versus commodities. It's a relative undervaluation of commodities currently compared to equities. So go ahead and take it away, Ronald, on I suppose on what this chart is telling us.
Yeah, well, I think that nowadays in this world where we're seeing massive intervention by central banks by basically manipulating the most important price in our economy, which is the price of money or interest rates. I think it's very important as many prices because of that are completely flawed. I think it's important to always have this relative view because it shows you a better picture of market action and of course of relative valuation. So what we did last year was we showed a chart of the GSCI commodity index versus the S&P 500, and it clearly shows a massive undervaluation of commodities versus the S&P, and the chart that you're showing here, it also highlights this relative undervaluation. It shows S&P in comparison to commodities and its long-term uptrend. And normally both prices hit this long-term trend line every 6 to 8 years. At the moment, there's a complete divergence, meaning that the S&P 500 would have to fall 40% to hit this trend line again, and commodities would have to rise 115% to go up to that trend line again. So, of course, I don't want to say that this is going to happen for sure, but I think the deeper look at history and this chart, it's putting things into perspective. It shows you that on a relative basis, commodities are just dirt cheap compared to equities.
Right. And if you look at that chart, it covers from 1970 to today. And, you know, interestingly enough, 1970 is roughly around the time when we went to full fiat currency system, basically, where all currencies were essentially trading versus one another with no backing other than the governments that pushed them.
Exactly. Yeah. So most of our charts, they basically begin in 1971 when Nixon temporarily ended the Bretton Woods Agreement and the backing of the US dollar with gold, because I think it's important to tell people that this started a completely new monetary era, and those monetary regimes they happen to change every couple of decades, and I think it's really crucially important to tell people that this is not a cyclical crisis, but it's a systemic crisis, and there's many consequences based on this kind of end game of the fiat money system. And yeah, that is something for some reason that almost nobody is really talking about, this long-term view on our monetary system, because, you know, monetarists, but especially Keynesian, they just say, okay, that's the monetary system that we're living in. We just care about the symptoms. We don't care about the root cause.
Right. Whereas the root cause is the most critical point of the entire situation. It's essentially why we've gotten to where we are today.
Absolutely.
So when we look at that first chart, we obviously see S&P, going, hyperbolic as far as compared to the mean. In slide 2, we have a tweet from you, which I thought was rather interesting, and it talks about monetary surrealism leads to complacency, and it looks like a Bloomberg headline. It says the stock market never goes down anymore. And you tweeted out that you'll definitely save this headline and use it for presentations in the near future. Just a little commentary on the euphoria that goes on when the stock market perhaps gets overvalued.
Yeah, well, that was a great Bloomberg headline from mid-January 2018, and we all know what happened end of January, beginning of February. That was basically the first big warning shot. We have seen that volatility was spiking. We've seen that there was some sort of a slight panic hitting the markets for the first time in ages. Now, we shouldn't forget that the biggest central banks created 15 trillion US dollars in the last 10 years out of thin air. And from our point of view, of course, it is this loose interest rate policy. It is globalized quantitative easing that created this everything bubble. So the complacency that we're seeing is mainly a consequence of this monetary surrealism that we are seeing. So, I mean, we're seeing it in the stock market, but of course we're also seeing it in bond markets. I mean, in a couple of years, people will just shake their head and say, you guys must have been crazy buying 10-year Italian government bonds with a negative yield, buying Argentina century bonds with a yield of, I don't know, 7%, and I think 1 year after they already have to kind of rearrange the bond.
Yeah.
So the terms, yeah. So this monetary complacency, this will end sooner or later, and I think the main reason, and this is also something that we are highlighting in the report, is this monetary tide that is happening. We're going from a globalized quantitative easing environment to a quantitative tightening environment. It is not only the Federal Reserve. The Federal Reserve will reduce its balance sheet by 420 billion this year. It will be already 50 billion on a monthly basis starting in October. That's quite a lot of money. So it's going to be 600 billion next year and 600 billion the year after. We're seeing that even the European Central Bank is becoming a bit more restrictive. It's the Bank of England. So it's on a globalized basis. Central banks are becoming more restrictive and they try to end this liquidity party. No, I don't want to be the party pooper, but I think it's time to say goodbye from the equity markets. We've had a good run, but once we're seeing people realizing that quantitative tightening is happening and that it's got consequences, because I think that people vastly underestimated the consequences of QE, and now they're in danger of vastly underestimating the consequences of QT. So I think this will be a major drag on the performance of financial assets, and on the other hand, it will be a very important trigger for the price of gold going forward.
Okay, and moving on to the next slide, another expression of very similar to the first slide that we looked at, but this is another expression of stocks versus commodities. It's the S&P GSCI Commodity Index for stocks. It's the lowest rating since 1999. It's basically the everything bubble except commodities, essentially, is what this chart is showing us. Anything different, suppose, or any other commentary different than
this report,
the first slide?
It's pretty similar. I mean, this was from last year's report, probably the one chart that was quoted or copied or even stolen most often. Jeff Gundlach, for example, he also used that chart. It is showing the GSCI Commodity Index total return. Of course, we can discuss methodology, but we had a good cause to use the total return index. But I think it just clearly shows you how cheap commodities are on a relative basis. And normally, James, normally markets tend to mean revert. And we are massively below the long-term median, which is at a ratio of 4. At the moment, we're at the level of 1, and we are far away from the highs, which are around 8 or even 9, I think, in the 1990s. Just 10 years ago, this ratio was at 8. So from a relative perspective, I think you cannot do much wrong if you buy commodities against the stock market, and I think it's important to say that normally a bull market is the mirror image of the bear market and vice versa.
Right.
So we should not forget that the last bear market in commodity was the longest bear market basically since the 1970s, but it wasn't only the longest, it was also the bear market with the biggest drawdown. So normally, technical analysis would suggest that this new bull market should also be above average. And I think this new bull market, it started in 2016. We are seeing at the moment, especially quite a lot of momentum in the energy space, but we can also see that industrial commodities and especially agricultural commodities are having a really hard time at the moment. But if you for I think the broad commodity complex, I think it's doing pretty okay, but at the moment, it's also very much a dollar story. I think I tweeted it a couple of weeks ago. At the moment, the correlation between gold and the US dollar is at the highest level in the last 25 years. So gold, for example, but especially in general, are very much of a dollar story at the moment, meaning weak dollar, strong gold, and vice versa.
Right. I think I saw a correlation of 0.81, I think. I mean, that's almost a 1-to-1 ratio, meaning exactly what you said, where at some point, you could see them both going in one direction together, but typically they do not. They go in reverse direction. One other point about that slide is that when you look at the everything bubble that we're in today, I mean, we're even lower in terms of commodities cheapness versus S&P than we were at the dot-com bubble. And it's just, when things get out of whack in nature on one side, they tend to revert and overshoot, right? So if the median is 4.16 and the last time we hit was 8 and we're at a lower level than ever, it's possible that we could shoot beyond 8 in this next go-round. So it's a very, very good chart, and it's telling, I think, for the 2020s, even to 2030, as far as where commodities could go in relative value. So moving on to slide 4, we're going to be talking about negative interest rates and why they may be here for a long time. I suppose you can explain what the viewers are seeing right now on that slide.
Of course. Well, we wrote, I think more than 1,800 pages of research and analysis about gold. And at some point we came to the conclusion, if there would only be one indicator or one number that is really important for gold, it is real interest rates or the direction of real interest rates. I mean, that's a very basic observation, but people tend to forget about that. And what we're showing in this chart is the real interest rates, the real Fed funds rate, and the gold price. And you can see that in the 1970s, of course, this big bull market after Nixon ended the Bretton Woods Agreement, gold rising from $30 up to $850. In this decade, we have seen mostly negative real interest rates. From 1974 till 1976, we have seen rising real interest rates, still being negative, but that's also the reason for this mid-cycle correction that we've seen, where gold corrected from $200 down to $100. Now, Then, end of the 70s, Paul Volcker came in and he brutally raised interest rates. He killed inflation. I think he was the most hated man. He caused some sort of a big unemployment and recession. But this also laid the foundation for a 20-year bull market in equities, for a very, very positive business environment. And in the 80s and 90s, as you can see in this chart, we have seen mostly positive real interest rates. And this was just a negative environment for gold because opportunity costs of holding gold were high. Now, since the year 2001, 2002, we are also seeing mostly negative real rates again. And I think going forward, this is probably the one fact that makes me most optimistic, because we are, compared to 2008, for example, we are seeing this over-indebtedness, not only on the side of the government, but also on the side, also now in emerging market countries. We're seeing it on a corporate level, and we're seeing it in the private sector. Just one number: the CBO's Congressional Budget Office expects for the next 10 years, I think, a total budget deficit for the US at, I think, 14 trillion US dollars. So it's gonna be every year it's gonna be above 1 trillion. But their assumptions are a bit optimistic or perhaps naive, because they don't expect any recession in the next decade.
Right.
Well, I would bet against that. That would show that probably the deficit and the whole new debt burden is going to be significantly higher in the next couple of years. And we're not only seeing it in the US, that's a global phenomenon. So the consequence is we simply cannot afford higher real interest rates. Negative real rates, that's probably the most important tool of financial repression, and they are here to stay. We just need them to kind of get the debt situation under control, and that should be a very, very positive foundation for gold.
Right. I mean, just to define, if you can, for our listeners, exactly what a negative real interest rate is. What does that mean in layman's terms?
Well, it basically is the interest level minus official inflation. Now you can also calculate it, of course, with 2-year, 5-year, or 10-year U.S. Treasuries minus the official inflation rate. You will basically come to a very similar conclusion. And of course, we can always discuss or criticize official inflation numbers, because they basically got nothing to do with real life.
Right.
We all know that inflation is highly subjective, that my goods and services that I'm purchasing are very different to the stuff that my parents or my grandparents buy. So from an Austrian perspective, those indicators, those baskets, they are pretty much useless. But still, we should not forget that 99% of the people still follow those indicators, those official inflation indicators, and that many other factors are linked to that. Of course, it's social service stuff that is always linked to those official numbers. And perhaps as a little side note, it is important. The Austrian School of Economics defines inflation completely differently. We go back to the root cause of rising prices. This is an expansion of the money supply. So if there is an expansion of the money supply, it has consequences, and those consequences are not neutral. So by raising the money supply 10%, it doesn't mean that everything rises by 10%. it's got also distributionary effects, of course, Cantillon effect, and so on. And what's important is to say that the first consequence of monetary inflation is always asset price inflation. And we're seeing massive asset price inflation. Equity markets, bond markets, real estate, monetary markets all over the world going crazy. So that's already the big consequence of monetary inflation. But the next stage is always consumer price inflation. And this is exactly what central bankers, but also politicians, really hope for. What they pray for, basically. And they completely disregard that we already have seen the second stage, which is which is asset price inflation. So this would suggest that we will hit the third stage soon, but once the genie is out of the bottle, it's hard to get it in again. So I think a negative surprise on the inflation side definitely is in the cards.
2 points to follow up on this. Obviously, it's in their interest. It's in the interest of a Western government has social benefits to underreport the inflation statistics. I mean, you have the Bureau of Labor Statistics. We have a note here of them talking about this in one of their reports. It says a mistake of just 0.1% in the CPI would result in an over or underpayment of almost $1 billion in annual Social Security benefits. That's just 0.1%. So imagine 1%, 2%. If they're underreporting, CPI by 3-4%, they're saving the government a lot of money, essentially. So the motive is there, and it's clear to underreport inflation.
Excellent.
The second point I just wanted to raise was you were talking about the 70s there, and people always talk about, well, do central bankers even care about gold? Just watch what they buy, not what they say. Obviously, in the net, they're buying gold, and they've been doing it for almost 10 years now. And secondly, Ron Paul talks about times where he's had meetings, and we get with Paul Volcker in the late 70s and early 80s. And when he'd get to the guy's office, he'd be waiting for him, and he'd come into the office, and the first thing out of his mouth to his handlers was, "What's the price of gold?"
Yeah.
Right? So I mean, it's you can say all you want, but you just watch what they do, and that'll tell you a lot. I guess the final slide we'll move over to. It's talking about obviously you've talked about increasing debt levels, right? And I think in the world debt supply, it's gone up from about 150 trillion to 250 trillion almost now. And a lot of that's in China, but also Western world QE and all the other programs that have helped to expand the debt supply. But right here, we're just simply looking at it looks like write-offs of credit card debts. A chart where it looks like every time it goes up and there's a lot of write-offs, around 6% or so, that usually is a signal for a recession. Currently, it looks like we're just over 6%. I still don't see a recession bar. So
yeah, I mean, forecasting a recession nowadays is a bit like forecasting that Germany will be kicked out of the World Cup very, very soon, which nobody would have expected before. But it happened, yeah. And so that's also a very, very important topic that we're featuring in the report. Recessionary fears will come up sooner or later. Why? Because, as mentioned before, we are seeing quantitative tightening. So liquidity in financial markets is getting tighter. And we know that there's a very, very high correlation between financial markets, especially the stock market, and spending patterns and consumer optimism and so on. We also know that the US consumer is highly in debt. We know that corporations are highly in debt. Just to give you one number, I think that was really, really something fascinating. In the report, we're featuring a great chart by Bianco Research, and they're saying that the number of zombie companies is at its highest level since at least the 1980s, I think. So what is a zombie company? It is a company whose interests expenditure is above the 3-year average of its EBIT, so of its earnings basically. And at the moment, that's roughly 15% of all companies in the US stock market. Now, we've got very, very low interest rates now, and still 15% of the companies are zombie companies. So that just shows you don't have to have a PhD in economics to come to the conclusion that those companies are highly fragile and highly sensitive when it comes to rising interest rates. The second thing is, I think that's also very important. As you know, we really like long-term charts, and in the report we've got some alternative recession indicators like the GE stock, for example, which is a great recession forecaster. Of course, General Electric was kicked out of the Dow Jones just recently because old economy doesn't count anymore. It's only the FANGs and so on. Right. But still, for us, it's important. But it's also a chart that we really like is a chart with recessions and interest rate cycles. So since 1900, 16 out of 19 rate hike cycles were followed by recessions. Right. Now we know that we have seen some very asymmetric interest rate policy, meaning that every time we raised interest rates afterwards in the bust or in the recession, they were lowered much more than were increased before. Now we hit the zero bound. Normally, in the course of a recession, interest rates are lowered by 500 basis points. If we do it like that, we will be deeply in negative territory, and then our friend Kenneth Rogoff will come out and will say, okay, now we have to abandon cash. Right. We're quoting him as well. And you should have a look at Amazon at the customer reviews of his book. Yeah. It seems people don't really like what he's saying. Yes, right. It's really interesting. Another point that we are making, it's by Lacey Hunt, said that since the early 1900s, every time money supply M2 decelerated, it was a precursor of a recession. Now at the moment, M2 growth decelerated to just above 2%. It is slowing big time. So from my point of view, there's many points, many indicators that suggest that a recession will happen sooner or later. And don't get me wrong, a recession isn't something that we have to be scared of. Right. It is something normal, something healthy for the structure of our economy, because it realigns resources. It is something positive, massive for the long-term structure of our economy. But of course, nowadays a recession will have massive consequences. Now, why is that important for gold? We crunched the numbers and we came to the conclusion that actually recessions are a great environment for gold, because gold discounts that there will be fiscal stimulus, that there will be monetary stimulus, and that other asset classes will have a hard time in a recession. So if you think that recessionary a recession is likely, gold is probably a pretty good hedge. One last point that I want to make is we always feature this chart where we have a look at the most important economists that are questioned by Bloomberg when it comes to their economic forecasts. Now, out of, I think, roughly 70 economists, those guys sitting at Goldman Sachs, at international institutions like the BIS, IMF, those guys with probably 8 PhDs, very, very sophisticated models and so on. How many would you say do expect a recession in the next 3 years?
It's probably on 2 hands. I bet I could count. Single digits.
0.
Oh, okay. Nice.
Nobody is seeing a recession. In 2007, how many people saw a recession?
Tell me 0 again.
0, yeah. So, I mean, that clearly shows
complacency.
There's such a strong market consensus,
Yeah.
and that basically most investors are also allocated for those kind of Goldilocks scenarios. So if recessionary fears come up, there will be a huge realignment of positioning in financial markets. There will be a big change in asset allocation, and I think gold is probably one of the very few assets that will do very well in that environment.
Right. And, obviously you mentioned there's debts everywhere. You're talking about corporate balance sheets where they're doing stock buybacks for years now. And like you said, about 15% of them are zombies. You have gap accounting, which was essentially dropped as a methodology in 2009 and hasn't been brought back. So nothing's been marked to market. Imagine what happens if you mark to market what's going on right now. You have car loans at record highs. You have college loans at places where they should never be. So I totally agree with you. And the fact that 70 people can't see this just kind of tells you that Keynesian model is still in effect. I suppose the final bonus little speculation I wanted to ask you about, you can't really have a intelligent conversation about gold if you're not going to talk about China and their efforts to try and wrestle away commodity price discovery mechanisms. What do you see currently? What's going on with China? Obviously, it's moving fast. It's a fluid situation, but obviously you've been doing this since 2007, and a lot's changed with China since then. So perhaps maybe what are you seeing of late from that side of the world?
Well, I just returned from a conference in Kazakhstan, Astana, a really interesting place, and Kazakhstan is one of the, I think it's the biggest producer or exporter of uranium. It's a big player in the oil and gas industry. Of course, gold and silver play a crucial role, rare earth and so on. And it's been a really big and interesting mining congress. And Kazakhstan is also interesting from a strategical point of view because it's basically in the center of Eurasia. And it was really interesting to see that there were so many Chinese delegates, official delegates, Chinese businessmen. You can tell that they're really interested in the commodities that Kazakhstan produces. That's just one example. I think that it's this picture that we're kind of or this analogy that we are making, that the most popular sport or game in China is Go, which is a very strategical game. While in the US it's probably, I don't know, baseball or football, which is, it's also strategical, but it's more of a kind of hit and run thing. Now, I really like American football, don't get me wrong, but I think it kind of shows you that the Chinese really have got a very long-term strategy. And this de-dollarization that we're writing about for a couple of years now, I think that's just a long process. That's happening. We're in the middle of it. Now the Petro Yuan that was established basically in March, with the new exchange where oil is traded in Chinese yuan terms, this was another major step. We have seen the gold exchange being launched last year. We are seeing that basically every day there is a number of new agreements between commodity producers, between emerging markets where they completely circumvent the US dollar and avoid the US dollar and trade in their local currencies. So I think we have to accept in the West that we're seeing a relative decline. If you go to Asia, if you go to emerging markets countries all over the globe, you can just feel, you can smell, you can taste that there's more growth going on, that there's much more dynamics than in the Western world. And normally, this is also something that we wrote a couple of years ago, gold always goes where the economy is doing well, where the capital structure is improved, where people build up savings. So it's coincidence from my point of view that the most important emerging markets are constantly buying physical gold, not only the central banks but also private individuals. So I think sooner or later, probably within the next crisis, I think we will talk about a monetary crisis and sort of a realignment of our global monetary system. And if you study history, gold always played a major role when it comes to introducing new currencies. And as Jim Rickard said, we're often quoting him. He's on our advisory board, and he says, if you want to play poker with the big guys, you have to bring golden chips to the table. And that's the reason why the Russians, they bought, I think, 600,000 ounces of gold last month. They dumped 50% of their US Treasury holdings. The Chinese are secretly buying huge amounts of gold. India is buying, Turkey is buying, and so on. But it's just a long process that we're in. And we should not forget that having the reserve currency, of course, it's a privilege, but it's also some sort of a curse. Yeah. So having the world's reserve currency also has massive negative consequences.
Right, like the disparity in wealth that we've seen over the last 30 years.
Exactly.
Right. Well, Ronnie, I want to thank you so much for coming on.